In the world of managed investments, there are two opposing approaches that fund managers take in forming an investment portfolio. They can either be an active or a passive manager. Starting with the active managers. As the word would suggest, these ones get active in buying and selling investment assets on your behalf. So let's say that this one active manager really likes the future prospects of XYZ Limited and thinks that its shares are trading at an attractive price. They might decide to invest heavily in these shares whilst reducing their holdings in other shares. So this is an active approach because the manager has confidence that they can achieve higher portfolio returns by making this change to their investment holdings. Now to the passive managers. To give you some history, in the 1960s and 70s, a group of academics started challenging the active managers with an idea. They proposed that if a fund existed where its portfolio was made up of all shares listed on an exchange, or at least a very large chunk of them, then the majority of active managers would struggle to outperform the portfolio in the long run. Their argument was based on two theories. The first being that financial markets were efficient, meaning markets factor in all available information, and the second being that market prices move randomly. The implication of the two was that an active manager was foolish in trying to predict which shares would be winners. As you can imagine, the active managers came in and said, well, that's nonsense because sometimes market prices can be irrational, as investors often respond on emotion. So we can capitalize on such opportunities. But in the mid-70s, a US company went and created one of these so-called theoretical funds, also referred to as passive or index funds, and soon many companies followed suit. So these companies kickstarted a new trend in funds management, where these new index funds were strong competition, plus they offered investors much lower fees because the approach required minimal research. And these passive fund managers also started diversifying their offering beyond a share market index, like ones for bonds and property. And today these passive managers have just as strong a presence as the active ones. Just for interest, have you ever watched the news and heard something like, the S&P ASX 200 went up 100 points today? Well, that's just an example of an index, and one that a passive fund manager might try to replicate when creating a portfolio. Right, so now you might be asking yourself, well, which do I go for, an active or a passive fund manager? Unfortunately, there's no right answer. On one hand, there always seems to be a handful of active managers that outperform the passive ones over the long term. However, the majority of active managers always seem to underperform passive managers after fees are considered. Tricky, right? So it seems to be down to personal preference in this area, but at least you now know the difference between the two approaches.